Hi, I'm Jimmy. In this video, we're looking at the fact that the Federal Reserve just cut interest rates to zero. This occurred last night, which was Sunday night. So first, we're going to try to grasp what's happening, and then we're going to try to grasp why it's happening and see if we can come up with a game plan for what we can do as investors. And then hopefully we can use this information to make better investment decisions and get us closer to our goal of achieving financial independence. Okay, so clearly at this point, the economy is facing huge headwinds. Even though, broadly speaking, the economy was doing okay before this Black Swan event started. By the way, we're not going to mention that Black Swan event. That way the YouTube algorithm doesn't really get upset. Now, we saw that the economy was doing okay in our monthly economic series, where we saw that things weren't great, but they weren't too terrible either. We'll do another one of those videos soon, and I'm guessing it's not going to be good anymore. Okay, so now let's look at what the Fed did. First, they cut interest rates down to zero. And we saw that just a couple weeks ago, they had cut interest rates by 50 basis points. 50 basis points is 0.5%. 100 basis points is 1%. So they cut it by 0.5% about 2 weeks ago, and they cut it again just last night by 1%. Okay, so this is important because this keeps banks lending and it keeps the financial system liquid, and the financial system being liquid is very, very important. And this isn't the first time that interest rates have been cut to zero. In fact, when we switch to a longer term chart of the Fed funds rate, well, we can see that they spent a ton of time down at zero as recently as December of 2015. So what does this mean for investors and for everyday people? Well, mortgage interest rates will fall, car loan rates will fall, credit card rates, they might fall, they should fall, but who knows? And in theory, the dropping of the interest rates should, or it will contribute to people spending more and could get the economy rolling once everyone is actually ready to go outside and start spending again. Okay, then the next thing that the Federal Reserve did is that they introduced another round of quantitative easing. Basically, in this round, the Fed is agreeing to purchase a minimum of $700 billion worth of assets over the coming months. So what does this mean? So basically, quantitative easing is when the Federal Reserve buys securities from, in this case, mostly banks. So the Fed announced that they would buy $500 billion worth of treasuries and $200 billion worth of agency mortgage-backed securities. First, the $500 billion in treasuries. So here, basically, they go to the bank and the bank sells the Federal Reserve maybe $50 billion in treasuries. Treasuries, don't forget, are US government bonds. So the government is buying their own bonds back from the banks. What this does is this allows the government to give the bank, in that case, $50 billion. Really, they wouldn't actually give them the money, they would just give them a credit. But ultimately, they can use that credit or that money to lend to people and businesses. So essentially, the Fed sort of printed money. It's a roundabout way of printing money, since really only the Treasury is allowed to print money. But either way, the result ends up being the exact same thing. And this works exactly the same way with the agency mortgage-backed securities. Now, a logical first question is, what is an agency mortgage-backed security? Well, an agency is really a government-backed organization. Think of things like the Federal Housing Administration or the Federal National Mortgage Association. We might hear them called FHA or Fannie Mae. If you're a new home buyer, you might get out a FHA mortgage. That's backed by the government. That's why the rules are a bit lighter there. Now, there are more agencies out there. Small Business Administration is a good example of another agency. But overall, this gives us an idea of what the agency is. An agency, the advantage that they have is that they use the full faith and credit of the US government to essentially guarantee the bonds, in this case, the bonds that are backed by mortgages. So by the Federal Reserve buying these bonds from banks, well, essentially, they free up the banks to lend more money. And in this case, since they're focusing mostly on mortgages, well, it seems that the Federal Reserve wants more people to buy more houses or refinance, I suppose, and that should help get things rolling from an overall economic standpoint. Now, let's ask a different question. Will this work? And as we could guess, this is a fairly complicated answer. And if I were to take a swing at it, I think the real answer is no one knows. And anybody who says that they absolutely know or it will absolutely work or not work, they're just guessing. It did in fact work in the Great Recession. And the economy, in that case, well, the economy fell apart. The Federal Reserve, the federal government stepped in and started things rolling again. Now, it wasn't just their doing. That wasn't the only reason the economy started rolling again, but it is one of those things. It's never just one thing. This is really just a tool that they're trying to use. In this case, the Fed is trying to use two tools. But here's one way that it could play out. By urging banks to lend more money, and that gives the banks more firepower now that they have lower interest rates and, in theory, more capital. Well, they go and they give that money or lend that money to the different participants in the economy. Maybe businesses, maybe people. But by printing more money, which is essentially what they're doing, the risk that they're taking is that printing more money tends to lead to inflation. Inflation is a bad thing for the overall economy. But oftentimes the Federal Reserve in this type of scenario might not be too concerned about it, because if people aren't going out and spending as much anyways, well, it's tough to have inflation. You might see food inflation since everybody's running out to buy as much food as possible, so prices could tick higher. Again, that could be a bad thing. That's a risk, but clearly it's a risk the Fed is willing to take. So if inflation doesn't go too bad and people do start spending again, well, the economy can once again resume moving higher once this whole pandemic is over. And this brings us to the stock market. How do we as investors handle this crazy volatility? Well, personally, I think it makes sense for us to put together, let's call it a bucket list of stocks. Just a handful. I would stick with about 4 or 5, but maybe a few more if you've done the research on them. And what we're looking for is we're looking for these stocks to hit crazy, stupid low prices. A price that we just 3 or 4 months ago wouldn't have believed it was possible for that company to hit again. Now, I'm actually working on my own list right now. That's why I'm suggesting doing this. I think it's a smart thing to do. What stocks, if I could get them at a certain price, what price would that be and what stocks are they? If they can get there, I'm going to get as much of them as I can at that price. If you're curious to see that, let me know and I'll put together a video going over the handful of companies that I think are the ones I'm waiting for and what price I'm waiting for them to get to and why. So let me know in the comments below if you want to see that. And then, and I can't stress this enough, we must keep our cool. These are crazy times right now. Look at the stock market. This is crazy. And I know I've quoted Warren Buffett before about being greedy when others are fearful. Well, this is the real thing. This collapse could end up offering such fantastic prices in companies that at the end of the day will still be there. There are companies that will survive from this and will do very well in the long run. This might be the exact opportunity that only comes around once every decade, maybe longer. Now, I would also caution away from trying to time the bottom too much. If we buy today, and then the stock market in general, and our particular stock, whatever one we bought, dips another 10% tomorrow, and let's face it, that is very possible right now, don't freak out. That's why we create our own bucket list of stocks, and what is the crazy good price that we want to buy them at, and then we just patient for it. Maybe it comes, maybe it doesn't. And if that happens, well, this could be the place that ultimately proves was the true start of our journey to creating our own wealth. That being said, my last video was a handful of forever dividend stocks that I like and that I've liked for a long time. Now, this isn't the same as a bucket list of stocks where I'm hoping to get at crazy good prices. Those dividend stocks are dividend stocks that I think are great buy and hold opportunities. And right now they're particularly appealing because at lower prices, we get a higher dividend yield. Those are companies that I think will continue to improve their dividend over the long run. Now, if you're curious, that could be a good next video for you to watch. There's a link right here. There's a link in the description below. And I want to thank you so much for sticking with me all the way into the video. Thanks. I really appreciate it. Let's try to stay as calm as we can, and I'll see you in the next video.